We got a late Brian Sozzi take here, and it's related to a lot of the themes we've been talking about this week for the retailers. Notably that the Delta variant doesn't seem to be slowing down consumer spending for a lot of those retailers. And as a result, Brian Sozzi, they're giving away a lot of money.
Yes, that is correct, Julie. And this is probably one of the biggest surprises from retail earnings this week. It's not necessarily that back to school has started well for Walmart and Target. I can understand that, but it is how that is quite the interesting graphic there.
It's unbelievable.
Nonetheless, I just caught that out of the right side of my eye. But nonetheless, it is the shareholder return some companies are now reinstating after really taking away at the height of the pandemic last year. We talked about Macy's yesterday. I'll recap it here. Reinstating a 15 cents a share dividend, also revealing a new $500 million stock buyback plan. That dividend was cut last year, and of course, the company hasn't been buying back any of its shares. Kohls also got on board with this. They're planning to buy 500 million to 700 million stock this year. Year to date, they've bought $301 million. Tapestry, the owner of Coach, Kate Spade, and Stuart Weitzman, they came out yesterday saying they're going to pay a 25 cents a share dividend. They had pulled that dividend at the height of the pandemic. Also looking to buy back $500 million in stock. And last but not least, Target, which is clearly the best performing retailer out of this entire group during the pandemic, they revealed earlier in the week a new $15 billion stock buyback plan, which I know caught a lot of folks on the street by surprise. I know also, Julie, last but not least, you flagged Carter's is really sneaking under the radar, reinstating its $650 million stock buyback plan, which would, if they complete it, would be a nice chunk of their market cap, about 10 to 15%. That's a pretty big plan.
Yeah, and it's interesting because even though this is definitely happening with the retailers in particular, and it maybe was most surprising in the retailers, especially given the outlook for some of them, we won't dig too much into Macy's again today, but of course that's a noble example. But buybacks generally have been really robust this year, right? Which is quite interesting given the bigger environment. Obviously, companies still have a lot of cash out there that they're willing to return to shareholders. But at a time when there's a lot of other uses for their money too, one would think, right? Especially they could be working on supply chains, which as we know have been damaged. Maybe there's only so far that money can go. But I don't know, guys. There's the age-old debate of whether buybacks and dividends are the best use of companies' money.
Yeah, I'll just add it from a retailer perspective. Right now, there appears to be two types of stock buyback plans. You have Target doing very well, but starting to come back off of their peak earnings that have been fueled by the pandemic. So I think they're coming out with this plan to help offset any weakness or potential weakness in profit margins for them and help pad their earnings. On the other hand, you have Macy's out here saying, look, we think our stock is undervalued, down about 55% over the past 5 years. We want to come out here, buy back our stock, really, really juice our earnings at the same time as sales are coming roaring back for back to school season. So a little bit two different plans here, I think.
I've been radicalized on buybacks over the last 9 years. Initially, I was, of the mind, they're terrible, they're just companies eating themselves, where's the innovation? But, I mean, if you think about what the goal of deploying your capital as a manager is you say, I have to beat a hurdle, right? If I cannot make more than X% over some rate, then I'm not making good investment. And if you look at your own company and you're growing earnings per share, let's say 11% a year, and you imagine over time the stock market will appreciate the value of your business growing earnings at that, effectively that kind of becomes your hurdle. So unless you have an opportunity to go buy something, invest in something that will generate a return on that invested capital in excess of essentially what your earnings per share growth is, then if you can't do that, then you got to buy back the stock. Stock buybacks are great.
Yeah.
But,
I don't know if you'll have anybody to argue with you here.
So, right, yeah. It's an extreme conversation, so I take the extreme position because, again, initially when I first, was figuring all this out, figuring the world out, I said, this is bad. And then I was like, no, it's good. So that's how things go.
I'm sort of neutral on this particular question. I will say, according to some data that Jared Blickery crunched yesterday, it looks like this year could exceed 2018, which was, I believe, the prior year in terms of stock buybacks. 2021 could beat it. So kind of interesting here.
We just need to do the average, though, of 21 and 20, because last year buybacks essentially went to zero-ish, right?
Hey, are we done yet? I have a grapefruit sitting next to me. I got to go eat it. We're good?
We got 25 seconds to the hard out. So
yeah, I'm very excited about this.
We can be done.
Hold up the grapefruit. I need to see this grapefruit. Hold it up.
I can't reach it. Just know that it's there.
It's not within reach.
It's not. Yeah, just know it's there.